In 1636, the Dutch Republic was the wealthiest nation on earth. During this economic golden age, the country became obsessed with a flower. The tulip trade exploded, creating what many consider the first modern financial frenzy. The most prized bulb was the Semper Augustus. A single bulb of this specific, intricately patterned tulip reached a price tag equivalent to the cost of a grand estate in Amsterdam. For centuries, history has treated this moment as the definitive cautionary tale. The standard narrative is that an entire society lost its mind to pure greed, inflating a speculative bubble before it all came crashing down. But a closer look at the actual trade records suggests a different story. A faction of economists concluded that the buyers in 1636 weren't crazy. They argue those high price tags were a rational market response. Economist Peter Garber champions this view. He analyzes the tulip trade strictly through the lens of efficient markets and fundamentals, arguing that high prices made sense for a rare, highly sought-after commodity. On the other side is Charles P. Kindleberger, a historian of financial crises. He analyzes the exact same event through the lens of behavioral economics, focusing on the psychology of crowds and the expansion of credit. This debate matters right now. When you see asset prices surging today, whether it's artificial intelligence stocks or cryptocurrency, you face the exact same question. Are you looking at a rational valuation of a new innovation, or are you getting sucked into a mania? Here is the core trade-off. If you assume every price spike is a bubble, you sit on the sidelines and miss out on the early gains of real innovation. But if you blindly trust that a surging market is completely rational, you expose yourself to ruin when the music stops. Tito Garber's argument strips away the emotion and looks strictly at the physical scarcity and breeding difficulty of the flowers themselves. The highly prized patterned tulips, like the Semper Augustus, took years to propagate. This chart shows Garber's view. A constrained supply meets intense demand, creating a price peak. Eventually, growers cultivated bulbs more efficiently. As supply increased, the price naturally fell. It wasn't a crash, just the normal life cycle of a new product. But there is a significant flaw in this fundamental theory. It explains the rare patterned tulips, but it cannot explain the high trading volume of common, ordinary garden variety bulbs. Those ordinary bulbs were traded heavily in local taverns by everyday citizens. They were buying and selling futures contracts for flowers that were still buried in the frozen winter ground. No one ever actually saw the physical product they were trading. Fundamental analysis is excellent at identifying the value of initial innovation, but it falls apart when trying to explain why capital blindly chases an asset that has zero underlying scarcity. This is where Charles Kindleberger's framework steps in. He shifts our focus away from the agricultural reality of the flower and looks instead at the psychology of the crowd and the expansion of credit. Kindleberger relies on a concept called the fallacy of composition. This is the idea that an individual seeking a quick profit is acting rationally for themselves. But when thousands of people do it at once, the aggregate result is a systemically irrational and destructive market. This flowchart maps out the mechanics of a mania. Novice buyers started purchasing these futures contracts with credit they didn't have. That new money drove prices higher, which attracted even more novices, creating a feedback loop that inflated the asset far beyond its real value. Garber criticizes this behavioral view. He argues that casually labeling extreme price volatility as a mania is simply a way for economists to avoid doing the complex math required to actually value a new asset. Yet Kindleberger looked at hundreds of years of financial history and found the same pattern repeated. When a speculative frenzy is fueled by easy credit and amateur participants, it ends in a panic. Behavioral economics gives us an accurate map of how market crashes actually happen. The risk of this lens is that excessive caution might lead you to dismiss a legitimate technological leap as nothing more than a temporary craze. To see which theory holds up, we have to look at what happened to the real economy after the tulip market crashed in February of 1637. Garber points out that the Dutch Golden Age economy continued to boom straight through the 1640s. For him, this proves the tulip crash was an isolated event in a niche agricultural industry, not a macroeconomic disaster. Kindleberger, backed by historians like Jonathan Israel, pushes back. They show that the crash did cause a localized economic slowdown because the widespread defaults damaged trust in regional credit networks. The Tulip fallout stayed contained within a specific market. But when speculative manias move from taverns into the core of the banking system, the results look like this: a complete freezing of the credit markets that affects every layer of society. The true danger of a crash is never measured by how far an asset's price falls. It is measured entirely by how deeply that speculative mania was funded by debt. Garber identifies the rational catalyst of scarcity that starts the fire. Kindleberger maps the irrational contagion of credit and crowds that lets it burn out of control. To navigate a modern market, you need to use both perspectives simultaneously. This is a decision flowchart for modern investors facing a surging new asset class. To process the noise, it splits your analysis into two distinct pathways: checking the fundamentals and checking the participant behavior. In the early stages of a surge, apply Garber's lens. Focus strictly on the asset's actual technological utility and its true scarcity. If those hold up, you can capture the early growth of a new innovation without constantly fearing the bubble label. But you must watch for a specific trigger to switch to Kindleberger's lens. When the market narrative shifts away from utility and toward the idea that prices will rise forever, and you see novice retail investors piling in with high levels of leveraged debt, the fundamental value no longer matters. It is time to exit. Executing this strategy comes with a painful, unavoidable trade-off. If you exit early to avoid systemic risk, you are explicitly sacrificing the final, steepest, and most lucrative gains of a bull run. You will watch other people get rich on paper while you sit in cash. However, losing 50% of your capital requires a 100% gain just to get back to zero. Because the cost of recovery is so high, protecting your core is mathematically more important than catching the absolute top of a market cycle. Surviving modern financial markets requires the intellectual discipline to hold two opposing views. You have to respect the rational value of innovation while actively fearing the systemic irrationality of the crowd.